You are 26 years old, healthy, and someone just tried to sell you life insurance. Your first instinct is to say no, because you're 26, because nothing has happened to you, because insurance feels like something people buy after their life gets complicated, not before. That instinct feels reasonable. It's also, according to the actual math of how insurance gets priced, exactly backwards. It rarely feels like a financial decision in the moment it's actually being made. It feels like an interruption, a conversation you didn't ask for, usually arriving right when life feels stable and uneventful, which is precisely the moment mortality feels like the least relevant topic in the world. Saying no doesn't feel like postponing a calculation. It feels like declining an unnecessary sales pitch. Nobody sits down, runs the actual pricing curve, and consciously decides that waiting is the financially optimal choice. They simply decline the conversation entirely, and the decision gets remade, by default, every single year the topic never comes back up. Here's the wrong step, the one nearly everyone takes without ever running a single number. You wait. Not because you decided waiting was financially smart. Because buying insurance felt like an unnecessary chore for a future version of yourself to deal with, someone older, someone with a mortgage, someone with kids, someone who would obviously need it more than you do right now. That future version of yourself is real. What most people never calculate is exactly how much that delay actually costs, in dollars, every single year they postpone the decision. There are 5 things that actually decide whether waiting costs you real money or costs you nothing at all, and once you see them together, I'll get around to it, stops being a neutral choice. Point 1, how life insurance is actually priced, and why the mechanism itself makes waiting expensive. Point 2, the bigger risk hiding inside waiting, one that has nothing to do with age alone. Point 3, why people delay this decision in the first place, according to the research on exactly this pattern. Point 4, the opposite mistake, buying too much too early without matching it to real need. Point 5, watching 4 people play this decision out over a few decades. Let's start with point 1. Point 1, how life insurance is actually priced. Here's the correct step, and it starts with understanding how life insurance is actually priced, because the pricing mechanism itself is the entire reason waiting is so expensive. Insurers price a policy using mortality tables, detailed actuarial data built from decades of real claims, showing the statistical probability that someone at any given age will die within the next year. That probability climbs steadily starting around age 30, and accelerates sharply after 60. Your premium is essentially that probability translated directly into a dollar cost. This means the price you're quoted at any given age isn't arbitrary or negotiable in any meaningful sense. It's a mathematical reflection of your specific risk at that specific moment, and the moment you're in right now, while young and healthy, is the cheapest that risk will ever be priced, for the rest of your life. It's worth pausing on why this pricing structure is so unlike almost every other financial product you're used to negotiating. A mortgage rate depends partly on market conditions that shift independently of you. A car's price can be haggled. A subscription's cost might drop with a promotion. Life insurance pricing doesn't work that way, because it isn't tracking a market. It's tracking your own body, aging in one direction, on a schedule that no negotiation, no loyalty discount, and no clever timing can reverse. The correct step starts with accepting that this specific price only ever moves in one direction, which means every year of delay isn't a neutral choice. It's an active decision to accept a higher future price in exchange for avoiding a small present inconvenience. Look at what this actually means in real numbers. A healthy 30-year-old buying a substantial term policy might pay somewhere around $200 a year. The identical coverage, purchased instead at 60, can run over 10 times higher, sometimes reaching well into the thousands annually for the exact same death benefit. This isn't a modest, steady increase you can shrug off. Research comparing rates across age brackets has found the jump from the late 50s into the 60s alone can represent an 80% or larger increase in a single decade. The cost of waiting isn't linear. It's closer to exponential, sitting quietly, invisibly, in exactly the years most people assume they still have plenty of time to think it over. Point 2. The bigger risk hiding inside waiting. Here's where the wrong step compounds itself further, because the price increase from aging isn't even the biggest risk hiding inside procrastination. The bigger risk is what happens if your health changes while you're waiting. Insurers don't just price you on age. They price you on health, and a policy purchased today, while you're healthy, locks in that healthy rate for the entire length of the term, regardless of what happens to your health afterward. Wait 5 years, develop a health condition during that window, even a manageable one, and you may not simply pay a higher premium. You may become considerably more expensive to insure, or in more serious cases, find certain coverage difficult to obtain at any price. The correct step recognizes that the "I'll get around to it eventually" plan carries a specific, quantifiable risk beyond the predictable age-based cost increase, the risk that eventually might not remain an option on the same terms it is today. This particular risk is easy to underestimate specifically because it doesn't feel imminent from where a healthy 20-something is standing. Nobody expects the diagnosis, the accident, or the slow-developing condition that eventually shows up on paperwork. That's precisely the point. Insurability isn't guaranteed to remain available on your current terms simply because nothing has happened yet. It's a window that stays open only as long as your health stays where it currently is, and the correct step treats that window as something worth locking in deliberately, rather than assuming it will simply remain open indefinitely until you're ready to walk through it. Point 3. Why people delay in the first place. Now let's talk about why so many people delay this decision in the first place, because understanding the actual psychological mechanism is part of the correct step, not just a footnote to it. David Leibson, an economist who has spent much of his career studying exactly this pattern, developed an influential model explaining why people consistently delay decisions that clearly benefit their future selves. His research describes something called present bias, a systematic tendency to weight immediate costs, like paying a premium today, far more heavily than equivalent future costs, like paying a dramatically larger premium a decade from now. Under this model, a rational, patient version of you fully understands that buying now is cheaper. But a nearer-term version of you, faced with an immediate decision that costs money today for a benefit that only matters in some undefined future scenario, keeps finding reasons to postpone it. Leibson's research shows this isn't a character flaw unique to careless people. It's a remarkably consistent, well-documented pattern across the entire population, showing up in retirement savings, healthcare decisions, and life insurance alike. What makes Leibson's specific formulation so useful here is that it doesn't just describe the delay. It predicts exactly when and how it happens. His model shows that the bias isn't a single, one-time failure of willpower. It's a repeated pattern, where the patient, forward-looking self makes a plan, intending to buy the policy soon, and then, when that specific moment arrives, the same present bias discounting kicks in all over again, pushing the decision one more increment into the future. This is why simply feeling convinced by an argument like this one, in the moment, rarely produces lasting behavior change on its own. The bias doesn't get defeated by a single decision. It has to be countered by removing the decision from the realm of ongoing willpower entirely, which is exactly what actually buying the policy today accomplishes, converting a recurring decision you'll keep failing to make into a single action you never have to revisit. The correct step here isn't simply willing yourself to overcome this bias through discipline alone, because Leibson's own research suggests that rarely works reliably on its own. It's recognizing the pattern for what it is, a predictable, near-universal tendency to undervalue future costs relative to present ones, and then deliberately treating the insurance decision as one where the immediate cost framing is itself misleading. The actual immediate cost of buying a policy today is genuinely small. The version of the decision that feels expensive, filling out paperwork, thinking about mortality, having the conversation at all, is an emotional cost, not a financial one, and confusing the two is exactly the mechanism Leibson's research identifies as driving the delay. Point 4. The opposite mistake. There's a second piece of research that complicates this picture in an important direction, and it belongs in the correct version of this comparison too, because buying too early or too much insurance carries its own version of the wrong step. B. Douglas Bernheim, an economist who has extensively studied how well households actually match their insurance coverage to their real financial vulnerabilities, found something that cuts in the opposite direction from simple procrastination. Examining detailed data on households approaching retirement, his research found that a meaningful share of families were significantly underinsured relative to what their actual financial dependents would need if a primary earner died unexpectedly, sometimes facing living standard reductions of 20% or more. But Bernheim's broader body of work on this topic also makes clear that insurance need isn't a fixed, universal amount everyone should buy at 18 and hold forever. It's a number that should track your actual dependents, actual debts, and actual financial obligations, which change dramatically over a lifetime. What Bernheim's research makes especially clear is that underinsurance doesn't distribute itself evenly or randomly across households. It concentrates specifically among families with the most at stake, households where one partner earns significantly more than the other, households with young children and a long runway of future expenses still ahead of them, households carrying substantial debt against a single income. These are exactly the situations where the financial consequences of an unexpected death are most severe, and Bernheim's data shows coverage in these households frequently failed to keep pace with the growing obligations, even as those obligations climbed. This is precisely the mirror image of the procrastination problem. It isn't simply that people wait too long to start. It's that even people who did start often never revisited the number as their actual financial picture evolved. This is exactly why the correct step isn't simply, buy the biggest policy you can afford as early as possible. A 22-year-old with no dependents, no mortgage, and no one financially reliant on their income has a genuinely different, and typically much smaller, insurance need than that same person at 35 with a spouse, a mortgage, and 2 young children. Bernheim's research on underinsurance specifically highlights that the households most at risk of real financial harm are the ones with dependents and debt whose coverage never scaled up to match, not necessarily the 22-year-olds who bought nothing yet because they genuinely had little to protect. So here's the correct version of this decision, holding both pieces of research together rather than picking just one. The correct step isn't buying an enormous policy the day you turn 18 regardless of your actual circumstances, because that ignores Bernheim's point about matching coverage to real financial need. It's also not waiting until you have dependents to even think about the topic, because that ignores both the pricing mechanics and Leibson's research on how procrastination compounds. The correct approach is buying a modest term policy early, while rates are cheapest and your health is likely at its best, sized honestly to whatever your current obligations are, even if that's simply covering final expenses or a modest debt, and then deliberately increasing coverage at each major life milestone, marriage, a mortgage, a child, rather than either freezing the decision entirely or overbuying prematurely. Sizing that initial amount honestly matters more than most people realize, because the temptation runs in both directions at once. A common rule of thumb multiplies annual income by some rough factor to arrive at a target death benefit, but even that shortcut only works well when it's applied to the actual obligations sitting behind it, co-signed debt, dependents, a mortgage someone else would otherwise have to cover alone, rather than treat it as a fixed number every adult should carry regardless of circumstance. Someone with no debt, no dependents, and modest final expenses might reasonably need very little coverage in their early 20s. Someone carrying a co-signed loan or supporting a family member, even without children of their own, might need considerably more, considerably sooner, than the popular image of, who needs life insurance, would suggest. The correct step treats this as a genuine calculation specific to your own obligations, not a number borrowed wholesale from a generic rule of thumb or, just as easily, ignored altogether because the generic rule of thumb didn't seem to apply to you. Point 5. Watching 4 people play this out over a few decades. Let's run both paths forward and see what a few decades of correct decisions, and a few decades of incorrect ones, actually looks like. Picture the person who buys correctly and early. At 25, they purchase a modest term policy, locking in a healthy rate premium that stays fixed for the length of the term regardless of what happens to their health afterward. As their life changes, marriage, a mortgage, children, they revisit the coverage amount deliberately, layering on additional term policies sized to match their actual growing obligations, exactly the kind of periodic recalibration Bernheim's research on matching coverage to real need would recommend. Decades later, they've paid a modest, predictable sum across their lifetime, locked in at rates that never had the chance to climb with age, and their family was protected at every stage along the way, without ever having paid for far more coverage than they actually needed in the earliest years. The layering approach also meant each new policy only ever needed to cover the incremental gap between what they already had and what their new circumstances required, rather than replacing the whole picture from scratch every time life changed. Now the person who delays, caught in exactly the present bias pattern Leibson's research describes. Every year, buying insurance feels like a chore for a slightly older, slightly more prepared future self to handle. By the time a real trigger finally forces the decision, a new mortgage, a first child, a health scare that makes mortality suddenly feel less abstract, they're often a decade or more older than they could have been, facing a premium that's climbed substantially simply due to age, and in some cases, facing a new health condition that either raises the price further or narrows their options considerably. The total lifetime cost of insuring the same amount of coverage ends up meaningfully higher, all because the actual decision, filling out paperwork on a policy that would have cost very little at 25, kept losing to the emotional discomfort of thinking about it at all. Worse, the trigger that finally forced the decision was often the exact kind of event, a health scare, a sudden diagnosis, that the entire structure of insurance pricing punishes most severely, meaning the delay didn't just cost more in an orderly, predictable way. It cost more precisely because it waited until the worst possible moment to finally act. Now picture the person who does the opposite of delay, and overcorrects. Spooked by exactly this kind of comparison, they buy the maximum coverage they can qualify for at 22, sized for a hypothetical future family they don't have yet, paying years of premiums for protection that, according to Bernheim's framework, vastly exceeds their actual current financial dependence. This isn't catastrophic, the coverage is genuinely cheap at that age, but it does mean years of premium dollars spent insuring against a financial obligation that didn't yet exist, dollars that could otherwise have gone toward building the very savings and investments that would have reduced how much insurance they actually needed once real dependence eventually arrived. And finally, picture the person who gets both pieces wrong simultaneously, delaying the initial decision the way Leibson's research predicts, and then, once dependents finally do arrive, panic buying an enormous policy at a now much higher age-based rate, paying the worst of both errors at once, the higher premium of late purchase stacked directly on top of coverage that, had it been built up gradually from an early, modest starting point, would have cost meaningfully less across the full span of years actually needed. Notice what separated every winning outcome from every losing one across all four of these paths. It was never simply, by early, or, by late, as a blanket rule. It was whether the timing of the purchase matched the actual pricing mechanics correctly, buying while young and healthy to lock in the lowest possible rate, while also matching the coverage amount honestly to real, current financial obligations rather than either ignoring the need entirely or wildly overestimating it in the other direction. There's one more distinction worth naming before closing, because it's a specific place where the wrong step can hide inside an otherwise correct decision to buy early. Term life insurance and permanent life insurance solve fundamentally different problems, and confusing them is its own version of the mistake this entire comparison is built around. Term coverage, priced according to the mortality tables and age-based curve described earlier, is built to protect against a specific window of financial vulnerability, the years when dependents exist and debts are outstanding, and it expires once that window closes. Permanent policies bundle in a savings or investment component alongside the insurance itself, and carry premiums that can run many times higher for the equivalent death benefit. For someone specifically trying to solve the problem this comparison has been describing, protecting dependents cheaply during the years those dependents actually exist, term coverage is usually the tool built for that exact job. The correct step includes understanding which specific problem you're actually solving before choosing which type of policy solves it, rather than assuming all life insurance products serve the same purpose simply because they share a name. Here's the reframe worth carrying away from this. The real comparison was never insurance now against insurance later as a simple either-or. It was whether you understood that the price you're quoted today is the cheapest version of that price you will ever see again, a mathematical certainty built directly into how mortality tables work, and whether you size the coverage honestly to your actual life rather than your fear of thinking about it, or your fear of not thinking about it enough. Leibson's research explains exactly why the decision keeps getting postponed. Bernheim's research explains exactly why postponing it, once real dependents exist, carries a cost far larger than the premium alone. You are never really choosing between buying life insurance now and waiting until you need it. You are choosing whether to let a predictable psychological bias make an increasingly expensive decision for you by default, or to make a modest, well-timed decision now while the actuarial math was still working entirely in your favor.